This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long at GordonTLong.com. It's my pleasure to have back with us again this morning Charles Hugh Smith, well-known writer, prolific writer on the web, who is the author, publisher of the websites of2minds.com. Welcome back, Charles.
Thank you, Gordon. Always a pleasure.
Charles, you know, after last month's show, we talked about what we might talk about this month before we broke, and I don't remember either one of us saying oil was the highest priority to talk about, but when you and I synced up for this, we both said independently we're going to talk about oil. How quickly and dramatic. It's not that it's a surprise, because we've been watching oil fall dramatically since June. It's been on everybody's radar screen, but just in the last few weeks it's really become front and center. Right.
It's actually in free fall, if you will, from the 80s to 68. That's a big drop in a major commodity.
The only thing falling faster is the Russian ruble, Charles.
Right.
And with Russia, 80%, 70% plus of their economy dependent on energy export, that's a big problem. And what's even worse is most of their funding is in U.S. dollars that they have to now pay back or pay the charges on with those smaller rubles. We have financial warfare going on here. Would you agree?
Absolutely. And so we have, I think we can talk about two things today. One is the financial impact on the global economy and also the geopolitical consequences.
Yeah, they're just totally intertwined, and there's a lot of real high-level strategy, in my opinion, going on here. It's more than just this is good for the consumer at the pump in the short term. Charles, you've written 4 great articles this week on with this title, "The Oil-Drenched Black Swans," and there's a number of key points in there that you brought up that I really want to make sure we have time for. But before we do, I just want to make sure from our listeners that haven't been following what's going on in oil, we start at a high enough level to really see the major issues that are going on. And one of them is right off the top here is the impact on liquidity that's being taken out of the system. We are taking the reductions in oil prices, which means the exporters of oil, the OPEC countries, and the non-OPEC. OPEC totals about $316 billion hit. And with the other OPEC, non-OPEC, probably half a trillion rather, we're talking about something getting to be comparable to taper. And this is money that they don't have, that one, impacts their economies to fund and puts many of them into a deficit, but two, doesn't allow them to buy assets. Assets that is collateral, which is underpinning our whole asset system right now. So this is of huge proportions. It's more than, it's going to be cheaper at the pump right now. And we had, what are the causes? And we had these 4 causes that we put up. Do you want to comment on the 4?
Okay. We have identified 4 primary dynamics here in this geopolitical financial matrix, if you will, around the fall of oil. The first is the rise of shale oil in the United States. That's been a game changer in the sense of providing somewhere around 4 to 5 million barrels a day in new production that no one foresaw 5 years ago or 10 years ago.
Amazing, isn't it? There was no discussion, and now it's this dramatic. It's changed the entire global balance.
Right, and so on a physical kind of commodity level, that has boosted supply in a way that as the global economy stagnates or weakens and demand falls, then it's basic supply and demand. You have more supply, weak demand, price drops. The second one is the weak global demand, and this is, of course, the happy story we're told by officials and central banks is the global economy is doing great and it's expanding wonderfully. But in reality, we know it's stagnating, right? And demand is down.
Yeah,
So
around the world, since the spring, the slowdown has been absolutely blatant to anybody that follows it. So when oil started falling in June, so did commodities all across the board, Baltic dry. So there's just no question the magnitude of the global slowdown is clearly there. Look what's going on in China right now, and they're trying to react because they're seeing it in a huge way. So the oil, we should expect oil to be falling just based on that alone.
right, and then I think the key point here is that the countries that export oil, and there's not that many, that export a lot of oil, they are dependent on the oil for their taxes, to support their government and to support their economy. And so this is called the resource curse, because what it means is if you can get oil and you've got a lot, it's just so easy to depend on it for all your revenues. But that makes you extremely vulnerable to any disruption in oil in terms of its price falling. So we're seeing governments like Russia, Venezuela, Iran, Syria, these governments that are highly dependent on oil, they're being crushed, right, by the loss of revenues. And I think we need to mention one aspect of this is, let's say a country has a cost of $50 a barrel and oil was $100 a barrel, they were netting $50 a barrel. Well, now that it's 68, their loss is much greater than just the percentage, the 37% drop in oil. Their net has plummeted by 75%.
Precisely.
So there's a leverage element here.
And they've leveraged their economies up with the expectations of $100 oil thereabouts. So now it's not there. They're into deficit in a large way.
Right.
This not only means they don't have revenues to pump back into the global asset market, Charles, it means they're going to have to sell assets to be able to keep the budgets going, flowing in the countries, because there's so many subsidies in these countries.
Right.
That they use to subsidize food, etc. So it's more than just the lack of selling, or buying rather. The selling itself could be a shock, another shock.
That's right, and I believe that gasoline in Iran and Venezuela and Nigeria, I think it's somewhere between 50 cents and $1 a gallon. So I mean, these are heavily subsidized for their domestic consumers. So of course they can kind of waste it because
I can hear our European friends just going, pardon, because they're paying. When I was last in Vienna and Frankfurt, it was like $11 a gallon thereabouts in Paris. So they're in U.S. equivalent. So that tells you the degree of subsidy. You're absolutely correct.
Yeah. So the third point we wanted to discuss was the geopolitical element, and you already mentioned the U.S.-Russia clash.
I believe, Charles, in a big way right now, that this is a financial war that's going on, and we heard about all the subsidies and not the subsidies, actually the reverse of that, that we were putting in place to stop or slow the economy in Russia as penalties over the Ukraine. But I personally believe that a big core of this, that we're using naked shorts, we're using the global financial swaps market to really push down both the ruble, and they've had to float it, and now they're attempting to shore it up, and energy prices and commodities from these exporting. So we've taken a big club in this financial war. Now that doesn't mean that there's not backlash into America from using this club. And I don't mean just militarily or from the reaction we might get from Russia, but also financially. But there's a lot of people that believe the same thing as I'm just saying.
Right, and I think that we can look at the basic geopolitical structure of the Mideast and see that the Saudis and the Gulf oil states are more or less on one side for religious and political reasons, and then Iran, Syria, and Russia are on the other, because Syria and Iran are allies, and Russia has been supporting both of those very, very heavily. So I think from the Saudi point of view, this looks like an opportunity to turn the oil weapon on its three primary enemies, Russia, Iran, and Syria.
But you're absolutely right, Charles, but additionally it puts the weapon against the United States shale industry, because suddenly now that $68, we're below the break-even cost of most of these productions, facilities that we've expanded. And as John Rubino's written, the junk bonds that were used to finance them now are highly exposed. So they may not have intended that, but they're also, Saudi clearly are taking advantage of that. And our opening slide that pointed from The Economist is indicating that too.
Yeah, and John, you mentioned Gordon. I'm sorry, Gordon. You mentioned John's comment about the debt that's been piled up on the oil. I call that whole dynamic the financialization of oil. Like it's not just providers go out there and sell stock and then sink a well and they earn income off that investment. There's a huge financial structure that's been erected on top of oil. The junk bonds, lots of derivatives, futures contracts, and I think that the oil is part of the shadow banking system, if you will. And I think this has been a conscious development on the parts of those making money off of financializing commodities. So they've built this huge tower of debt on the collateral of oil, and now the collateral's been reduced by 40%.
Absolutely, Charles. It's a huge issue. The central banks are pumping out liquidity, but liquidity is not capital, and it's not collateral. Because they're pumping it out, they're actually taking collateral out of the market as they take bonds back as part of quantitative easing. So there's a huge collateral shortage, and this is going to make collateral even harder to find. But it's been highly leveraged, as you correctly point out, based on the value and the expected revenue streams that are also have been collateralized on it. And that's it's like pulling one of the chair legs out from under a chair, and whether the chair tips right over or just gets really tippy, next 3 or 4 months is going to be telling. This is something that's so serious that to play around with oil prices this dramatic is globally destabilizing. We've never seen anything like this. And even back in 72 and 73, when the petrodollar came into existence, we weren't playing around with these kinds of moves, this dramatic.
Right. And I think that for all the sort of happy story that we're told by the governments and central banks that the global economy is stable and everything's going great, that is totally at odds with like a 40% drop in oil. I mean, there's just a huge disconnect between the happy story that everything's fine and oil plummeting 40%. Yeah.
But if you look, it's not just oil. You look at commodities, you look at Baltic shipping rates, you look at production. It's right across the board, the slowdown is accelerating. Look at the countries now that are already in recession in Europe, and we have Germany on the verge of it right now. So these are the only happy story is the United States right now, and with north of 50 million people on food stamps, I'm having troubles understanding how this is a happy story.
Well, Gordon, you were mentioning the liquidity, and I think that for people that may not know what that means, I'm going to ask you to explain more of it. But it starts with revenues, right? In other words, revenues is the foundation of any business, or in fact, any nation. So what we've been talking about is what you called our situational analysis is the impact of lower oil is impacting oil exporters' revenues. It's impacting the monetary policies of central banks. It's impacting trade flows and global financial markets. And so when you mention liquidity, I just want everybody to know we're really talking about multiple layers of the global financial system.
Oh, without question, Charles. And just from a monetary standpoint, this now means that we have deflation at a bigger rate than most were anticipating, and it's already deflation. Our lack of inflation in Europe is forcing Draghi to print more money. This situation now is going to give the United States Federal Reserve and Bank of England excuses to not increase rates, and possibly to go back, and here we go with another round of quantitative easing if it gets worse, because there's such a shortage of liquidity that's floating out there, and more importantly, a lack of collateral or a corruption of the collateral, a falling in the collateral. You know, Charles, banks can only lend money if somebody's posting collateral. They just don't hand you the money. You have to have some kind of asset or some kind of revenue stream to pledge. And the Federal Reserve has been taking all of that collateral back in many ways by quantitative easing into the Federal Reserve. So the primary dealers have been buying it from the Treasury, but they've been immediately turning around and through the repos, etc., passing it back to the Fed and making interest rates. But they need that on their books to be able to lend out more money. So they need cash coming in, deposit money coming in to leverage it up. And when you suddenly get leverage money falling off, cash falling off, you've got a problem in doing that. And I was just looking at some statistics from GavCal that were showing that for the commercial banks, their non-reserves, it had fallen by close to just under $300 billion here in the last few months, and it directly matches this fall in oil, which is suggesting there's just a slowing liquidity issue at the stake. Ever mind my point here on collateral and capital, and not to make it too confusing, but we're messing with the plumbing of how the system works. And when you mess with these plumbings and you spring a leak, it's very, very tough to fix this on a global basis. That's the problem we have right now. That's why I stress how serious this can be unless we get some stability going here. And stability is not $68 a barrel or falling.
Right. And so then that ties into the geopolitical issue we were discussing, which is some players don't want stability. They want to destabilize their geopolitical enemies. And so there's a balance here that you described as rather fragile. And I think that's an absolutely perfect word for it, because financially they can't control the risks that have been unleashed by dropping oil into the 60s.
I don't think they fully understand them.
Yeah,
it's like in Russia, or rather in China right now, they don't understand the magnitude of their shadow banking system, and when they try and tighten with credit, it comes apart at the seams, and they have no choice but to increase bank reserve levels, or reduce them rather, so that they can pump more money out. Everybody's kind of caught in the trap and having to react to it, so they don't fully grasp or understand it. Right now, I listen to George Fisher, or rather Stanley Fisher, the vice chairman, saying that, well, this is going to be good for the United States economy because the consumer is going to pay less at the pump. True, we're going to spend money less at the pump, Charles, but I would argue I don't think that's going to flow into just a lot more consumption. I think it's going to flow into the existing debt. In other words, I'm putting everything on credit to try and get by, and because I've got an extra dollar, that doesn't mean I'm going to go out and spend it. It just means less money that's going on to credit this month. That's all. It's less credit growth, if you would. Maybe that's too much of an exaggeration. But I'm looking at HELOCs, so home equity loans starting to grow. I'm looking at the car loans and the subprime we have there. There's just no question that the job reports that just came out are all, they're jobs that are not a standard of living, a wage earning living. Can you live on them? I don't know if you saw the same thing. And so there's just a lack of money.
Right, and so I think we could characterize what you just described as the rather modest benefit to the households with a few hundred extra bucks.
There's some, yeah. But it's modest because we're so stretched.
But the financial consequences are extremely consequential. I mean, they're stupendous, and a lot of it's being hidden from us. The losses have been hidden. It'll take a few months for the chain of events that we were describing to become visible. And Gordon, you mentioned a couple of other things on your chart on the situational analysis that I think are very interesting and complicated, but worth studying. One is the drop in oil prices means that the U.S. will be importing less oil and paying less for oil that it does import. And so that means that the trade balance in the U.S. actually tightens up. The trade balance will be less, which means we'll be exporting fewer dollars, which means there'll be fewer dollars available for people who have borrowed money in dollars overseas. And so we've discussed this kind of complicated issue before, Triffin's paradox, right? The world needs U.S. dollars to pay down debt and service debt. And if our trade balance declines, we're issuing fewer dollars for them to use. Dollar goes up, and that is another pressure on these oil-dependent countries.
Absolutely, and all of the emerging markets that have really taken advantage of the U.S. dollar squeeze. So we have about $3 trillion, Charles, in the last 5 years, has moved outside of the United States, borrowed in the United States, and been invested abroad. That money is payable in U.S. dollars, and in the carry trade, the cardinal sin is make sure you borrow in a currency that's going to weaken. Well, what's happened is the United States dollars got stronger, so you've got to pay the interest on your weakening currency as this currency is getting stronger. So there's been a lot of hedging and covering, and we've been witnessing, well, in the emerging markets, about 2.3 trillion of that. So there's been this dollar short squeeze that's been going on. That's what's really driven the dollar up so dramatically, because you've been on the wrong side of this cheap trade with the expectations the dollar would weaken, and it didn't. But now it's accelerating. It's getting, as you just point out, it's going to make it even worse. That's why this thing could really skyrocket, go up like a rocket ship. But Charles, the thing that's troubling me the most from this is in the United States right now, we have low interest rates and we have a pension problem of unmitigated proportions. Right now at the state down level, we're about just under $4.7 trillion underfunded. Federal government about $3 trillion underfunded. Corporations, I would guess, close to $1 trillion. So we're starting to get within spitting distance of $10 trillion of unfunded pensions. And we've got these pension plans buying, getting out of bonds, but with no interest, getting into stocks. What happens if stock markets start to collapse? A lot of these pensions are still trying to recover from the dot-com bubble in 2000 when it lost capital, and some of the capital in 2008. And it's not a United States problem. It's a European pension problem. It's a Japanese pension. Look at what the Japanese pension is doing. The biggest one in the world, $1.3 trillion. It's selling bonds to the Bank of Japan and taking the money and buying equities in the Nikkei and in foreign equities to store some level of value. So if this starts to get out of control, and again we're back to this word collateral, because these things have all been used for margin and extra loans to leverage up. If that starts to collapse, this is huge. I don't believe for a moment the central banks or the governments will allow that to do. So I believe what they're on is a forced acceleration of more printing and to shore these assets up. So if this sustains itself, you've got quantitative easing 4, 5, and 6 coming at a huge rate, because no matter what, they've got to keep those asset prices up.
Right, Gordon. And but as you mentioned earlier in the show, the consequence is interest rates will stay near zero, which means all those pension funds are earning nothing in safe investments, and so then they're pushed into riskier investments. And let's take an example: London real estate. You know, at the high end, all this oil money's and liquidity's been pushing, London real estate up. Well, now that market's imploding. Why? As you said, $500 billion is vanishing in income. And so we have to make a distinction here between income and borrowing all this like liquidity. So as you say, they can pump the global system full of credit, but that doesn't replace income. Yeah,
and that's the right word. It's credit that's going on. And income is savings, which is the basis of capital, the capitalist system. And that income or savings is what the basis of the banking system needs. Because it's only when they've got $1 that they can lend out. I would used to say $10. Now it's, who knows, it's almost infinite. But they still need somebody to put $1 of real on deposit. The next stage, Charles, in my humble opinion, will be that the government will simply print money and hand it out directly to the consumer level under some auspices. I don't know, student loans will all be paid for, or anything else, so that liquidity actually will be capital at the basis of the banking system. When you do that, you kiss your currency goodbye.
Right, and it's interesting too, Gordon. You mentioned
that's when hyperinflation arrives.
Yes, and I think that we can look, if people want some evidence for that, you can look at the weaker currencies, as you mentioned. The ruple's been a target. The Venezuelan currencies heading obviously to off the cliff. And so you can look at how these currencies weaken and then collapse as the revenues collapse. And I don't think anybody's really figured out how those dominoes will fall. You can't destroy one currency after another and say, oh, there's going to be no effect on the global financial system.
I remember as a kid, we had a little cartoon called Humpty Dumpty. And when it breaks, nobody really knows how to put it back together. And that's the problem we have. Charles, we have to wrap. Any concluding comments you'd like to make for our listeners?
Well, Gordon, I think we should mention the idea that the oil head fake that I wrote about it's simply this. It's easy to turn the tap off, to shut the wells down when the prices drop below your break-even point. But it's very difficult to get production back up. The timeline for developing new fields is in the years or even decades. And so what we could see is a lot of supply being shut off here as prices plummet. But when demand goes back up, there's not going to be that same supply, and price could really soar as a result of that.
It always does. This is a consistent pattern we see all the time, and the real shock becomes when it spikes up later, because there's a lack of supply because of all the pulling in of the capital. And
that's right.
That's the process we're going in. So minimally, in another 18 months, there could be another boomerang shock we're hit with.
Absolutely, and I think that's the last point I would make, to look out 18 months and see this is a temporary spike down.
Sounds like a lot of instability.
Yes.
Charles, with that happy note, I have no idea what we'll talk about next month, but I always enjoy our dialogue, and I just hope our listeners find it of value. Talk to you again next month.
Thank you, Gordon.
Okay, bye.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.